Where are you, Kyle?
Chicago Airport right now.
Oh, that's right. You were.
Yeah, I got 1 hour for you guys right now. It's 6 o'clock local. It's 5 o'clock local right now. So 1 hour.
Mauricio, did you do your top? Did you do the top 10?
You got the top 10 for me, right?
Oh, I forgot to do the top 10. I forgot about it.
Of course, I knew you were going to forget.
Wait, let me research really quick. No, I wanted to do the top 10, which is the worst top 10s. And it doesn't matter. Kyle's gonna be gone. I'll think something.
Welcome to Drunk Real Estate. Grab a drink and enjoy the show.
Hey there, and welcome to episode 28 of Drunk Real Estate. I am Kyle Wilson, Ashley Wilson's husband, and I am joined for the second week in a row with the fearsome threesome, my co-host, starting with Mr. Jay Scott. How's it going, Jay?
I am doing well. Shout out to, can I make a shout out here?
Of course, go for it.
I was going through our podcast stats, and apparently we are hugely popular in, guess what countries? Mauricio, guess.
Kazakhstan.
That was number 4.
Nice.
Denmark and Qatar.
Wow.
Really?
For some reason, we're loved in Denmark and Qatar. So if we have any fans out there in those countries, leave us a comment on YouTube and I'll send you something.
Maybe we'll have to travel to Denmark and do a live episode there. I wouldn't mind.
Dude,
that.
I'm going to Qatar. You guys go to Denmark.
I don't even know where Qatar is.
You drinking today, Jay?
Yeah, I decided to do a repeat of the Knob Creek that you turned me on to. I liked it, and Carol is on some medication this week, can't drink, so I have nobody to split a bottle of wine with. So I'm doing the bourbon again, or yeah, are
you the source of the medication? Why she's on medication?
Normally. That's completely different medication.
Nice. All right, Mauricio, how's it going, buddy?
Anybody see? By the way, can anybody see Kyle, or is Kyle just like in complete darkness over there? There we go.
I go in and out. I got the laptop camera going this time instead of the good setup. So, and I got to rock the Eagles hat. I just got to support them no matter what, even if they lose on me.
You look like a sports announcer right now, and I'm down for it. I like it.
I feel like I could do that.
He's got a mic he's holding up. He's got the big lights behind him. He looks like he's in a stadium. I mean, look at this crap. Looking good.
Sports announcer in an SNL skit. Mauricio, how's it going, buddy?
It's going great. I am rocking the new Bar Down Investments sweater hoodie,
Sexy.
Which is freaking warm as can be. I love it. Appreciate it. But more importantly, I'm really pumped because I emerged victorious in the fantasy football, the most important league, which is between the three of us. I crushed you guys. I was 3-1 against you guys. Is there a trophy for that, Kyle, for winning the drunk real estate portion of the fantasy football? Because I'm 3-1. I'm almost undefeated. I'm undefeated since week 2 because I lost week 1, but like I crushed it. Kyle?
Yeah, you lost week 1 to me, so we split 1-1, and you put it in the suggestion box for the league manager for next year, and maybe we'll put a special prize just for you, and you could pick which guys you want to include, even though you came second last.
Love it. I'm 3-1. I'm celebrating. So I'm celebrating with, dude, I haven't had this wine in a long time. And I not only used to enjoy it, but the new label is killer. It's like a silver and black sterling. So it's a winery here in Florida, in Napa, which I've been to actually. And it's actually pretty good. But yeah, I love the bottle and it's tasty. So yeah, I'm enjoying it.
Awesome. Finally, we got our buddy AJ over here. How's it going, man?
Doing good. I am drinking a Diet Coke, same thing I'm always drinking, but this is I like it right out of the fountain. So it's very bubbly and crisp. Good year.
The real stuff. Awesome.
How about you, Kyle? Where are you?
I'm in the Chicago airport right now, and I'm sitting in a restaurant, and I was hoping that we started right away, and I was hoping that the waitress would come over and ask me for a beer before we got started, but she hasn't. So maybe she'll come over and I'll flag her down, and I'll just I don't know what's the symbol for a beer, and maybe she'll bring me one.
I don't know what the symbol is for beer, but I know that is not it.
That's not it.
All right, I'll try something else. But hey, let's get this moving because we have big news here. The pivot party has started, hasn't it? Has the pivot party started? Well, last week, Jerome Powell and the Fed released a statement and a press conference with a decidedly dovish undertone. And everyone just took this as confirmation that they indeed do plan to start cutting rates early next year. So what happened? The market absolutely just ripped after that meeting. So Jay, should we be getting out the balloons and champagne, or should we still have reason for caution here?
I'm gonna interrupt Jay before he even starts, because I have a question, because this has been bugging me the whole week. So I'm gonna start with a question, Jay, and then you can answer it. But did the Fed themselves say they were going to start cutting rates next year? Because everybody seems to say, "Oh, the Fed said this, the Fed said that." The Fed said we're cutting rate next year. Is that what they said?
First of all, I'd love to thank both of you guys for like basically just giving away the whole segment.
Oh, then we can just skip Jay. All right, AJ, you're up. You're up.
Well, they only said they were going to cut 3 times, so it wasn't that they were going to,
But to Mauricio's point, they didn't actually say that. So let's let Jay explain why everyone thinks they're going to be cutting.
Yeah, so they didn't say that, but okay. So here's the big question, and something we'll take a poll after I'm done talking. But the thing to think about, and the answer I want: did the Fed screw up last week with what they did? And so with that question asked, let's jump into what they actually did. So they had their meeting, their committee, FOMC committee meeting, where they got together and they basically announced no rate hike for December. Not a surprise. Nobody expected a rate hike in December. But what they did do was they put up, or they announced a couple things. One, there was a dot plot. And so dot plot, we've talked about this before, but it's basically when the Fed committee members, 18, 19, 20 of them, kind of give their opinion on where rates are going to head over the next quarter, the next year, the next several years. So here's a graph that the Fed released last Wednesday. And again, it's basically indicates each dot on this graph. If you can't see it, I'll explain it. But each dot on this graph kind of indicates where a Fed committee member thinks rates are going to be at different points in time. So if you look at 2023, every single one of the committee members said rates are going to be between 5.25% and 5.5%, which is because we're at the end of 2023, and that's already been decided. So there's no chance that's not going to be true. But if you look at 2024, basically what you see is there are no committee members that think rates are going to be higher in 2024. There are 2 of them out of the 19 that think they're going to end 2024 exactly where we are now. But most of them think we're going to be somewhere between 4.25% and 5% federal funds rate. Go into 2025, and most of them fall in the 3 to 4% range. Go into 2026, and we're actually below 3%. So long story short, a lot of these folks that actually are the ones that vote on whether rates get cut or not, or get hiked or stay the same, a lot of them seem to think that we're going to basically trail off over the next 3 years. Rates are going to get down below 3% by 2026. Now, again, this isn't a decision that they're making. This is just their opinion. But they are the ones that are going to vote on this eventually. So it is meaningful to some degree. So they released that dot plot. That was number one. In addition, they basically said, Jerome Powell came out and he said the same thing he's been saying for 2 years now, which is we need to fight inflation. We need to take whatever measures are necessary to fight inflation. But the way he said it this time was a lot softer than the way he normally says things. And when he talks, people parse his words. And it wasn't so much him saying it, but after the speech, he takes questions. And it seemed like every journalist asked the same question, just 20 different ways. Are you planning to cut in 2024? And basically the response was, if we need to cut, we're going to cut. And it was the first time in a couple of years that he really conceded the fact that they're going to likely cut rates if they need to. But there was one specific question that I think kind of triggered a lot of excitement. And that was one of the journalists asked, would you wait until there's economic softening to start cutting rates? Or would you cut rates if we don't see a recession, if we don't see any economic softening, but inflation continues to come down? And I think this is where he made a big mistake. The response I would have expected was, if we see economic softening, we'll start to cut rates. If we see a need to cut rates, we'll cut rates. But his response was, if we see inflation continue to trend down towards 2%, what that most likely means is that we're in too restrictive a territory with our policy, and we would definitely consider cutting rates. And so basically, he admitted that we don't need to see a recession before they're going to consider cutting rates. We could have a soft landing. We could have inflation come back to 2%. And after 2 years of saying we're going to keep rates higher for longer, he's now admitting that there's a reasonable chance that they will start to cut, even if there's nothing, there's no cracks in the economy that necessitate it.
The problem with it, though, is because like when he said it, everybody's going, but he mentions one point, right? And it's like not inclusive of all the other points. And so I think that's what I get scared about when it's not specific. It's not like they actually mapped out to assume that that's a yes, because the only point that I think he went on to say that means they'll lower them was if inflation, right, is below 2%. But that's not, it doesn't happen in a vacuum like that. So it doesn't automatically mean because inflation has dropped and maybe it's under 2%, it doesn't automatically mean that that will happen. But he's saying we could and we would look at it, right? But I think the market just took it like, no, that means we're under 2% right now. If that keeps going, that means they're going to, right? So I don't know.
I think another big thing that the market was hanging on to, though, is the market was pre-pricing before this meeting a cut in March, right? And usually when the market kind of gets ahead of its skis, Powell goes out and during his speech and during the questions, he kind of checks them and he says that's premature. You know, we shouldn't be doing that. He didn't do that at all. He didn't make any comments whenever they brought about potentially cutting. He did the boilerplate like, oh, if we need to cut, we're going to cut, basically. But he never said like, I think that's premature. So that's why the market was basically saying, oh, he's agreeing with us. They could be cutting in March.
How much? I've heard this question a few times, but how much of the information that the Fed is getting does everybody else have access to? So one person was stating like, well, they see things we don't. And this was an interesting question because you're talking about, right, what he's saying from what he's reading. Now, is there, Jay, a bunch of information that the Fed is getting that the open marketplace, these huge banks, firms, traders, everything else, are not privy to or do not get? Can he see things that everybody else can't?
I don't know. It's a great question. And honestly, I don't know the answer to that question. Now, I will say that they have, unlike me and probably you guys, except maybe AJ, who has a team of folks probably, but unlike most of the world, the Fed has folks whose job it is to analyze this data and to run regression analysis on the data and to do other statistical analysis on that data. They also have access probably to more historical data than we do or easier access to historical data. So they can do comparisons. They can look at trends. They can see how things shook out in the past when certain trends are happening. So even if they don't have access to more data, and they may, again, I don't know, and I'll do some research on that for next week. But even if they don't have more data, they certainly have more people and expertise at analyzing the data that they do have.
And probably a perspective too. Like if they've been around, you know what I mean? Maybe a perspective onto the inner workings of how that stuff actually works. I mean, some of these banks are obviously really smart, but I don't know.
Yeah, maybe the perspective's another way to say it. My understanding, just from listening to everybody else here, is that they definitely have their models, right? So even if they have the inputs that the same as everybody else, they have their unique models. And I think I presume they're proprietary, but it's because there's been a lot of critique about their models. Like even if they have the right data, they've got the wrong models. Is kind of the big criticism. And so everybody's got their unique models, and so they may put in the same data, but they may come out with different information. But the one thing I wanted to point out, which is, and I think I've mentioned it before, but maybe I can crystallize it better, is that, everybody talks about the rate cuts, but they treat all rate cuts the same. It's like, oh, rate cuts equals something good, and this is what's going to happen with rate cuts. And they don't really get into the nuance of why there is rate cuts, right? So is the rate cut because the Fed on their own decided, hey, everything's great, we have a soft landing, and so we're going to voluntarily start reducing rates next year? Is that the rate cut? Or is there a huge recession and the bottom's falling out of the market, and that's why they're in panic mode and like, crap, we got to cut the rates because, it's a free for all kind of like
But I think that was the good thing that came out of that meeting is they implied that there is a path for them to just start cutting rates, even if nothing happens, even if like everything's just going well, that they will start cutting rates. And he's never really said that before. Like he's implied it based off of dot plots and things like that, the soft landing, yada, yada. But like, this was the first time that he kind of came right out and said like, hey, like there's a path for if things just trend the way they're supposed to right now, we're going to start cutting rates.
Right, but everybody makes that assumption, right? Rate cuts equals blank, whatever they're pushing. Like, rate cuts mean, prices will go up, real estate will go up because, they'll be whatever, it'll be cheaper to buy and blah, blah, blah. And what I'm just focusing on is it just because it cuts, the reason why they get cut is important. And I think everybody's kind of overlooking that because that'll change the whole scenario. If they're cutting because they have to, and it's panic mode and they're the lender of last resort, and that's why they're cutting, that's a much different environment than if we have a soft landing and they're cutting because, hey, inflation has gone down to 1 or 0.5%. And they're like, hey, we want to cut it.
Yeah. And I think this was one of the saying, buy on rumor, sell on news, meaning basically the market reacts a lot more to things they think are going to happen than they do when things actually happen, because by the time they happen, all the stuff that is already priced in. And so what happened after this press conference last week was, as AJ alluded to, the markets kind of went crazy. Stock market is up. Well, over the last 60 days, the market's up 15%. But on Friday, 2 days later, after the good news kept coming, we saw $21 billion flow into the S&P, which was by far the most money that's flowed into any market in history. The VIX, which is the volatility index, and that drives a lot of things in the market, option prices and insurance prices. The VIX, the volatility, was at the lowest level that it's been in years. And so that's an indication of optimism. Typically, we see a high VIX, a high volatility, when there's pessimism or confusion in the market. But that basically says that investors are optimistic and
they think they got it right. So it means there's not a lot of hedges. I mean, you don't have two sides that are being taken. So all the money is going in the same direction. So everybody's thinking they got it right, and everybody's making the same decisions.
Yep. And then the other big thing that we saw, and we saw this immediately after the press conference, actually we started seeing it during the press conference, was treasuries started to drop. The 2-year treasury dropped, the 10-year treasury yields. Yeah, the yields dropped. And so if you recall, we were close to 5% a month and a half ago, which was a crazy number. Nobody expected us to get that high. And now we're down below 4% for the first time in a couple months. And I mean, that's a huge drop in a month, but it's an indication of expectations. Mauricio talks about this a lot, that the treasury yields are a gauge of expectations for inflation.
And all markets are. I mean, when you look at these markets,
growth and inflation expectations.
Yeah.
Yeah. It's something that we talk about a lot, even with our acquisition team. Like, you've got to find deals. If you wait till you hit the bottom, then there's no more deals because the expectations have changed. So the market participants say, oh no, it's going to be better now. So I'm not coming down on my price. And so markets get ahead of themselves. And that's why we see big fluctuations.
Yeah. And then so with treasuries coming down, the other big thing we saw was mortgage rates start to drop. And so we've got mortgage rates. They were a couple months ago, 7.8% was the high. And by the way, I need to pat myself on the back. A year and a half ago, June 2022, I did a Facebook post where I said my prediction for rates maxing out. And I talked about yield spreads and why I thought I predicted 7.6%. We maxed out at 7.8. Thank you.
Well done.
Well done.
If you throw enough predictions out there, one of them's bound to be right.
100%. And let me pat myself on the back for this one because I get most of them wrong.
You just delete off Facebook all the ones that are wrong, and then nobody knows. So it's okay.
I just assume that everybody's too lazy to go back and fact check.
AJ's got an entire assistant to do that, just to go back through old posts and delete the ones that aren't right.
So here we go. So the markets are going crazy. Treasury yields are dropping. Mortgage rates are dropping, which is I don't know if they're going to drop low enough that it's actually going to impact the market anytime in the near future. But my question is, all of this was a result of Jerome Powell basically getting up there and taking a very dovish stance compared to where they've been the last several months. And I don't know if it was an accident. I assume nothing he does is by accident. I wonder if they realize they've overcorrected. Maybe, as AJ alluded to, maybe they have data that we haven't seen that says that they're a little bit worried and they want to spur
Maybe
the
they
market
want people to
bit.
spend money in Christmas.
Yeah, maybe. But here's the question. So here's the question. Did he make a mistake by doing that? Because the risk we face is if people start spending money at Christmas, if people start buying houses and cars and all those other things, because now they think
Inflation goes up.
inflation goes up and basically we're back where we were a year ago, where the Fed's freaking out and now thinking about how they're going to fight inflation. So what do you guys think? Did he make a mistake?
Well, I think they've already gone too far because their data that they use is so lagging. So they're basing all of their decisions off of lagging data. And if you look, there's much better data out there. I talked about before with the Penn State in inflation gauge, like it's already sub 2, it's already like 1.7, and that tries to take into consideration the major one that takes out the lagging effect of rents. It tries to keep more updated, like to the minute rents than our 6 month, 9 month old rent data that the Fed is using. So I think that they already went too far, and so like it's just how much they're going to have to be playing catch up after this.
So you think this was purposeful and a good move?
100%. I think they should have done it earlier. I think they could have smoothed it out a little bit. Like instead of taking such a hard-nosed stance every single time on previous ones, it could have been a little bit more dovish. Instead of the reason it ripped so much is they completely flipped. He's been so hawkish every other meeting and then just went complete dove. He could have just smoothed that out a little bit, but I think it was overdue for him to take a dovish tone and kind of like just let everything calm down. Because like we went up to 5%. You said up 5% treasuries for no reason. Like it was crazy. And then this is just bringing back to normal.
I'll take the opposite side of that coin. So I think, for us, we're obviously super sensitive to it because we're in real estate. But one of the problems we have is the cash reserves and employment. So employment is so low. And when you're looking at the cash reserves of these companies, everybody's been pulling money out. So we're seeing organically the job numbers start to change, but it looks like instead of having mass layoffs, it's just not replacing. That's very different, right? And so it looks like the market was slowly coming in on that side of things. People were apparently their cash reserves were lowering, but people haven't stopped spending. So all of a sudden, I think the worry is if the market overreacts, which by the way, I think it totally did. I think it totally overreacted. They think that it's just over and rates are dropping. It's kind of crazy how everything went up. And all of a sudden you have mass cash come off the sidelines and start doing acquisitions, mergers. They start buying up things and we get velocity of money moving. I worry that all of a sudden we will have a short-term spike because the market overreacts, and that will cause them to just pull it all back. And especially I'm fearful of this in an election year because, well, we'll talk about that later. But I worry that the market, not necessarily the Fed, but the Fed's response and how they didn't actually come out and say they were going to lower rates.
But AJ, even if that happens right now, that's not even going to be reflected in the data for inflation for months and months ahead. So we're not even going to see that effect of it happening. So there's going to be a lot of I just think that the actual inflation data is much lower real time right now than what we're seeing in those reports every month. And so that yes, if that happens, that's going to be reflected in inflation data 6 months from now. And it's already going to the damage is already going to be done.
I guess my thing is when you look at the prices for Main Street, so the common stuff, which that's what they really care about. We're talking bread, cars, eggs, transportation, gas, right? Things like that. We've seen cooling off, but as far as Main Street goes, we just haven't seen that big of a cool off on all these.
Do people
prices.
actually eat that many eggs? Like every single time when people talk about inflation, they bring up eggs, and I always thought it was such a weird thing that, like, yes, you eat eggs, but like it's like people are acting like that's the most important thing. Like eggs went up so much,
Dude. When you're going all Gaston and you're eating 12 dozen a day.
Yeah, but remember, egg prices are so affected by like all the diseases. Sometimes they got to like kill a bunch of chickens, and they got to like there's so many other factors involved.
It's got a household full of fucking Gastons from Beauty and the Beast just chugging eggs every day. I don't know what's going on.
We eat a lot of eggs in my house.
Milk, holy crap! I go for like 4 gallons a week now. It's ridiculous.
Okay, Mauricio, what's your vote?
Whether they made a mistake or not?
Yeah,
I think none of this is a mistake because they fully focus on the narrative. So for them, it's all expectation policy. So they're doing everything intentionally. It doesn't really matter if, to Kyle's point, if inflation's currently at 1.7, it's whatever comes out of their mouth. They are trying to move the markets based on what they're saying, and they're successful at it. So when they say something, people react. And so it's almost like the self-fulfilling prophecy. Like they say something, which causes the actors in the market to do something, which results in the actual result, which means they don't actually have to do anything. So, so I don't believe that anything that they do is not intentional. I just think that it's more what they say than what they do, because that's their main tool right now. And it's working. Look at them. I mean, they just said something and suddenly, boom, interest rates not collapsed, but went down significantly.
Well, that's why they track inflation expectations, right?
I think that's my worry. I'd rather see them actually do something and we see real interest rates start to come down, as opposed to not do it. Interest rates are still high, activity picks up, and then we get into a bad spot.
Well, let me leave it with this, because I think we're getting long on this segment. But on Friday, there were a couple speeches by a couple other Fed folks. I don't know exactly who and what their role is.
I think it's the Chicago. I was looking at the same thing. The Chicago Fed came out. Austin Goolsbee said something. Yeah, that's probably
exactly.
Yeah,
and they kind of. I don't want to say they contradicted Powell, but they basically took a harder nosed stance of, hey, this is not what he meant. And I'm wondering if maybe this started to get away from them a little bit, as AJ alluded to. And they wanted to rein things back in a little bit, and so this was kind of damage control.
His actual quote, it was, and I quote, "It's not what you say or what the Fed chair says, it's what do they hear and what do they want to hear." And that was coming from the Chicago Fed president, Austin Goolsbee, that said basically the Fed is not pre-committing to cutting interest rates soon, and they believe the market kind of just jumped on expectation, which is what they always do.
Yep. And that answers your question, Mauricio. I think you already knew the answer, but that you started the segment with, which was, did the Fed say they were going to cut rates? And no, they absolutely did not say that.
So what you're saying is I got to put the party balloons on hold, and we got to wait a little bit here.
It means that Survive Till 25 is alive and well.
There you go.
Well, let's take this opportunity to pivot a little bit to just a small pivot, because we're going to keep talking about the Fed. But let's talk about the Fed in 2024 going forward, because up until this point, it was pretty clear what they were trying to do. They were just trying to get inflation down as quick as possible with as little effect on the stability of the economy. But now 2024, it's kind of a big year. We have an election coming up. And when we're moving into an election cycle, like, they need to consider how their actions are affecting the political outlook. And it's the Fed's policy to remain neutral when it comes to politics. But I have a feeling, AJ, that hasn't really been the case in previous election cycles. What do you have to say on that?
This is a hard thing for the Fed to walk, because the Fed needs to react to market conditions, and obviously they don't get to control timing of recessions, things like that, or market conditions. But I would actually venture to say their largest scare is to look political, because the moment they do that, then they create enemies and people start to go after them. And
half those enemies have guns.
That's right. And it looks bad, because you're like, that's the whole point of it, right? Is to not be connected to the government. So you can look at history and see there's a huge change during election years. The Fed, what they do is they stop doing anything. So the Fed has only one time in the 2 months coming up to an election raised interest rates ever. And so the Fed, let me see if I can share this here real quick with everybody, and I'll explain it.
I don't know if that's possible without one of your assistants, AJ. You sure you're able to do this?
I'm going to try my best, but I don't have a lot of high hopes for it. So, all right. So when we look at election cycles and the Fed's decisions here, we have the one time, which was right before 2008, that the Fed lifted up rates, which we know that recessions are basically political suicide. I don't think one president has ever survived a recession through an election with a recession. When we look back on it, one thing that we'll notice in the years building up to it, though, the Fed will actually, they're obviously keep things the same, but they're not as worried about dropping rates. But they still, you get too close to the election. The only times that they've even gotten close to it is when they absolutely had to. And this was in dire situations. Other than that, the Fed is not going to make those changes. When we look at this, this brings in a lot of questions because let's say the Fed maybe actually thinks that they should be dropping interest rates or even increasing them. This will be a factor in their decision. If they think that they can get away with not, they will. They'll not do it, even if they think it would be good. They're going to hold off because of the chaos it can cause. Now, this is especially true in election cycle like we have coming up. Colorado just announced that they won't let Trump even be on the ballot. So this is going to be one for the ages. And I think the Fed and what we saw with the Fed, they're walking this tightrope where, I bet you we'll probably get halfway through the year and they want to bow out. They don't want to be involved. They don't want to be a talking point by political figures. This is really, really important to them. And I think the timing of all this is really bad, really bad. We are in a place where the Fed has now decided that they're going to change their stance and no more rate increases, right? For now. But also, I think everybody's saying, like Kyle, we need rate cuts. At some point, you got to be more aggressive in actually switching this, which
in the market right now is pricing in up to like 6 cuts next year. So like if what you're saying is true, there's no way they're going to be able to cut 6 times then.
No. And so I think that unless like things really, the wheels really come off the bus, they're not going to want to do something. And that makes the whole situation that much more messy. It really does.
They can just cut. They can get the cuts done in less than 6. I mean, they can go from where they are now to they can do one quick. Look, it goes back to what I've been saying earlier. I think so. Yes, I 100% AJ. I mean, the stats bear it. What I'd be interested in though is during those election years, how many times have you had a major economic crisis, right? Because again, going back, and I know I'm harping on this, and I sometimes sound like a broken record, but we talk about cutting rates because the Fed wants to cut rates, and then there's cutting rates because they have to. So yes, I agree with half of that, where if they get to decide whether to cut rates or not, then yes, it's election year. They don't want to mess around. Got it. I'm with you. But again, if the bottom falls out of the market, they're going to cut. And it's election year. That's interesting. But if the stock market's plummeting and it's down, 2,000 points a day like it was the last time, they're just going to cut. If there's a huge economic crisis, they're going to cut. Now, whether it lines up with the election year or not, that's
well, they waited in 2008 till after. They waited till after the election. And two, when you look at their actions in the past, it's really important to notice. And I think that this is what they're doing. So my stance is this: the Fed is not going to cut. Instead, what they're going to do, and if they do, it'll be in the first 6 months and it'll be very small. Instead, the Fed is doing this. They are going to start, I think, aggressively lowering their balance sheet, which they are. And so they're already doing that. And that was one of the reasons that the market, I think, turned, because they said, all right, we know if you're going to offload your balance sheet, then that means rate cuts are going to be on the way in. I think that they're doing that instead. So they're going to try to go through the next year where not focus so much on the rate cuts. Why? Because that's what's political. Everybody sees the rate cuts. Instead, though, they can work on the balance sheet and affect things while not being political and not hitting Main Street, and it can still have an effect. So they're going to take out the QEs. They're going to start to unload assets back onto the market, and we're going to see this quantitative reverse easing from the Fed through 2024, and then you'll get more aggressive into 25. And so I think that there's ways they can affect it that aren't political, and that will be where they go.
Yeah, and this is exactly. I'm sorry.
No, I was going to say, I'm pulling up the data. So in 2008, 50 basis point cut October 8th, 50 basis point cut October 29th. So 100 basis point in the span of 3 weeks. And then after the election, 100 points. But even last time during COVID, they cut 150 basis points in basically 13 days, right? Because the shit was hitting the fan. So again, if they have the choice, I'm with you. But they have to. That's their job. They're the lender of last resort. That's their job. They're the lender of last resort. If the shit hits the fan, they're supposed to step in and provide liquidity and do whatever they can to give the market.
But the market could really suck, and everybody says they should lower rates, and they won't unless they're forced to. So maybe in a normal year, they actually would have cut rates and tried to get it down. But now instead, they're going to go, we don't want to be doing anything. So if they can avoid it, I think they will, even if it's the wrong thing to do.
Yeah, and I think we saw that in 2020, and basically the Fed used other tools besides rate cuts in 2020. We were doing stimulus, we were doing QE, and luckily, I think for the most part, we avoided the accusations of politics because everybody realized that we were screwed and they needed to take action. And I'm not sure they could have lowered rates any more quickly than they did. So certainly 2020 was an anomaly, but it's just a good.
They hit zero pretty fast, so they couldn't go any lower.
Exactly.
The economy also hit zero, so it literally stopped.
Yeah, but it was a good example that the Fed does have other tools at their disposal, and they'll use those tools. Now, in 2020, 2021, what we saw was that a lot of those tools were very obvious. We saw the QE, we saw the stimulus, but as you said, AJ, they can simply roll things off their balance sheet or add things to their balance sheet to increase the money supply. They can buy mortgage-backed securities and treasuries. They can sell mortgage-backed securities and treasuries. So I mean, they can behind the scenes. And again, none of this is private or unknown. It's all public, but people don't pay attention. Journalists don't pay attention. We all look for the rate cuts.
It doesn't affect their debt right in front of them, right? It's not.
What's different this time, which will be very interesting, is that before, when they cut rates violently, right, literally 100% cut, like whatever they were at, they went down to zero because we were pretty close to zero. Since 2008, we've been at, we haven't really been that much above zero. Now we're significantly above zero, right? We're at this 5.5 number. It'll be interesting to see how quickly they cut. Like, obviously they can cut down to zero, but will they cut down to zero? Will they cut 100 basis point first and then another 300? Will they get down to zero, or will they say, well, no, we can't go from 5 to 0? Well,
the Fed has previously stated they don't want to be at zero. That's not a goal of theirs.
Well, again, want and need are two different things, right?
Yeah. But I mean, right now, I think that's what's surprising. Look at interest rates where they're at, and our economy hasn't collapsed. I don't think anybody even thought that was possible literally 3 years ago. And so I think, too, the biggest question, though, and I think the scary part of all of this is the Fed and where we're at today is so much more Keynesian than prior. And a lot of people are discussing this now, where look at our segments, because everybody's like, well, what's the Fed going to do? And we now know what the economy is going to do. It didn't used to be like that. It didn't used to be like every single investment thesis was predicated whether the Fed did this or that, where today, honestly, your investment thesis, if it does not include the Fed, it cannot be a good thesis. Because you just can't beat it. And I think that is something that the Fed wants to get away from. I think they want to return and get their balance sheets clean, and they want to return to some more normal thing where it's not like the market, they control everything, because when they do that, they appear political whether they want to or not. And that's a dangerous position for a central bank that is not a political entity, to all of a sudden everyone to think that they're the gods of the economy, and they don't want it. And I really don't think they do. And they want to get out of that position.
And when you say Keynesian, you mean when things go bad, they want to intervene? Is that what you mean by Keynesian?
No. So Keynesian, meaning that like the idea that the government is like the Fed, central banks are the ones that manipulate the market completely, that they're the ones that are really involved. And it's the government's place to be doing that all the time. Because in the United States, that's not how we're set up, right? And that's why the central bank is something different. So the central bank is not one of the three branches for a reason. And so the idea that the government should be controlling the economy is actually completely not how we're set up or structured. So if it starts to, that's when people say unelected officials now have control. That's their fear, because that threatens the whole thing. And that's what they do not want to be in.
Yeah, they don't want that because they've come out and said, it's like, hey, there's only so much we could do. We've got to now look at the fiscal part. Like, you guys have to start doing some stuff on your end. And it's like there's gridlock over there. We're kind of forced to do stuff ourselves on the monetary side. But I've heard them come out and say, hey, there's only so much we can do. It's the government's responsibility and Congress's responsibility to do a lot more on your side. You guys are just not doing anything.
Well, look at 2008. How long did they wait? And basically they were ticked. They told Congress, you need to enact these measures, right? We need to do other things. It's, we shouldn't want to. And we don't want them. Nobody wants them to be in that position because that's bad for everyone.
But that's what happened last time, in 2020, it was the CARES Act, right? So it was like the Fed didn't have much room to manipulate. So they went from 1.25, they cut it, or it says 1.25 down 150, doesn't make sense. But whatever they were at, 1.25, 1.5, cut it to zero. That wasn't enough. The market didn't respond. If you guys remember, the market was collapsing. It was like 1,000 point. Dow was down 1,000 points almost daily. It was like crazy. They keep cutting. The Dow still goes down, keeps going down. And it wasn't until they announced the CARES Act, all that influx from Congress, that the stock market stabilized and the market stabilized. It wasn't the Fed. It was actually Congress acting. So again, it'll be interesting to see again this time if when the Fed starts acting, if they're going to go with that or they're going to wait for Congress to come out with CARES 2.0 or some other huge program to.
Does anyone else think it's actually like pretty interesting how mum Biden has been about the performance of the Fed and what they're doing? Because we all know that our previous president, like Trump, he was very critical of everything that the Fed did, and he came right out and said what if he liked it or if he didn't like it. But this is Biden's kind of let that go. Do you think that's like on purpose to try and separate the two of them, or do you think he's going to start making comments on it?
I don't think he will. I mean, I think historically it's been frowned upon for the executive branch and the Fed to talk to each other publicly, and hopefully they're not doing it much privately either. I obviously we can't know that for sure, but we all know Trump was the type that the way he negotiated was he used public pressure. And he would get up and use his pulpit and use the backing of his followers who are very, very loyal. And whether you love him or hate him, and I'm not a huge fan of Trump, but I think his ability to get things done.
You're a Trump closet lover. You know it.
I did not like Trump. But I give him credit for using his ability to leverage his pulpit. And everybody's heard the term bully pulpit, and that's what he had, and he used it well, and he strong-armed the Fed presumably to make some decisions that whether they were good or bad for the country, they were good short-term for his presidency. And I think in retrospect, I think a lot of them were good for the country. I don't fault any of those decisions. But I want to talk about something else real quick, because we talk about the perception and the risk of the perception of the Fed being political. Obviously, that's bad. But if you go back, and I'm going to bring up a chart here, if you go back like 30, 40 years, there's been plenty of research that's looked at like what is the implication of an independent Fed versus a politically motivated Fed. And back in the 80s, Harvard did a bunch of studies, and we've done some empirical, meaning academic institutions and government organizations have done some empirical studies. But basically what we've seen is that and for those that can't see this, it's a graph that shows basically all of the countries, major first world countries with central banks, And basically they're graphed on how politically independent they are versus historic inflation, average inflation in those countries. And what we see is using metrics that Harvard developed 40 years ago, those Federal Reserves that are most politically independent have seen average inflation lower historically than those Federal Reserves in countries that have been more politically not independent.
It's one of the most important things, and I don't think people understand it. It's because if the central bank is political, it can be weaponized, and not by public pressure, not by somebody even saying they want something. And that is very dangerous, I believe.
So the lawyer in me can't help me, but I saw that the source of that graph was Garriga, which I don't know who that is, but where does this source come from? Like, that's the easiest way to knock an argument, is to attack the source. I'm like, who is this Garriga guy putting the source together? Like, is it like your grandma, or is that who is Garriga?
Well, it is true, because what it's shown, what they have lots of problems is when the Fed is more tied to political parties use it to lower interest rates to incentivize the economy. And like the old saying goes, the moment people find out they can vote themselves money is the moment that the country and the economy ends. And it's very true. It's one of the problems I believe we have in the United States. People have really figured out we can vote ourselves money. And Trump figured that out too. I can literally buy the economy to do well. And that's why he did it. And I think that's bad.
And so for your knowledge, Mauricio, and I'm surprised you didn't know this because I thought everybody knew this, but Garriga is Anna Garriga, who is an economics professor at the University of Essex. And I'm kidding. I didn't know that. I just looked it up. But
I thought it was Garriga. I was looking it up. I thought it was a Cuban actress, and she played Marie in Mission Impossible. Is that not her?
I think that might have been her sister. Both Garrigas. But yeah, so it looks like it's an economics professor from Britain. But like I said, there's been both theoretical and empirical data, studies and data that have supported this going back 40 years. So I don't think it's overly controversial.
And the best example of this is my hero, Paul Volcker, that big, bald, beautiful man. He basically tanked Carter's presidency. Paul Volcker is the reason Carter got destroyed. Because he let interest rates go up. Huh?
He didn't do it to destroy Carter.
No, he didn't do it to kill Carter. No, he did it because that's what needed to be done. But if Carter was a president that was like, no, I'm going to force this, he would never have let that happen. It was political suicide, but it had to be done. And so the Fed did, and Paul did what other ones, I believe, haven't been willing to do. And he let, despite the political pressures and everything, interests go up and throw us into a recession.
So knowing all this, how do you think the Fed is going to react going forward then? So if we assume there's going to be some sort of cut happening in the beginning of this year, are they going to do a couple cuts and then just shut it down because they don't want to do anything too close to the election? Or how do we think that's going to play out?
I think they will not do anything they don't have to do. I think they are going to try, the closer we get to elections, they are going to stay away unless they absolutely have to. And
so what is that, AJ? What do you think? Do you think they're going to cut twice, something, the March and then one more after that and then shut it down? Or
yeah, maybe. I think twice and then no more after that. I think like I said, I think they're going to affect more because of the balance sheet. So the Fed will offload the balance sheet, and that's going to be their move through the year, more so than cutting interest rates.
So keep in mind that next year there's no FOMC meeting in April, August, and October. So basically that it reduces without those August and October meetings, it reduces the likelihood of anything major happening right before the election. Obviously there's still July and September. But I'm going to say zero chance of them doing anything in September, a month and a half before the election. And I would agree with AJ. I think this is what he's saying, that they probably wouldn't do anything in July, unless they absolutely have to. So
let me push back on that a little bit, that if they absolutely have to, they call emergency meetings. That's what they do.
That's true too.
If they absolutely have to, of course, I think they will.
Mauricio is obviously still holding strong, and he thinks something's going to break pretty heavy, and we're going to have a recession, and they're going to have to do a heavy pivot.
Yep.
All right. Let's. Should we move on to our final segment here? I got to get going, boys. So I'm probably going to introduce this segment and then leave it. I'm it's unfortunate. I was really looking forward to listening to Mauricio's top 10 this week, but I'll have to listen back at it after. So let's talk some SEC stuff. We had a few discussions in the past about the long-awaited update to accredited investor regulations, and the SEC just released a new staff report on the definition of an accredited investor. That's a tongue twister. It's a pretty long document, so luckily we have our resident SEC geek read it for us, so that no one else has to. And so, Mauricio, does this give any new insight into what the new regulations are going to look like?
So this is why I love this show, this podcast, is because it's so timely. So this literally came out on Friday. We're recording on Tuesday. This will get released Wednesday. A shout out to the editors who get this thing literally turned around in less than 12 hours. It's crazy, or 12 to 15 hours or whatever. But so the SEC has been talking about updating the accredited investor definition, and Friday they came out with a report. So let's talk about it. First of all, let's just step back and see why it's so important to investors in real estate or whatever. So a lot of people who are capital raisers, who are actually raising money for larger deals, a lot of their deals are limited to people who are accredited, people who are high net worth individuals, $1 million in net worth, excluding primary residence, or have earned, basically earn a couple $100,000 a year. So if you're an LP out there, somebody who's an investor and want to invest, like if you want to go invest some money with these guys here on the pod, you've got to be accredited. And so that's a big deal. And so there's been a lot of rumors about the SEC wanting to increase the limits of being an accredited investor. So right now it's $1 million. If you have $1 million in net worth, you're accredited, excluding your primary residence. But there's rumors that that might go up to 10 million or 3 million or 2 million or some higher number, which means a lot of people will become.
Because they made the regulations, back in early 80s or something?
1982. Yeah, 1982. And so they came out with this report primarily because they have to. Every 4 years, so when Congress passed the specific regulation back in 1982, they required the SEC to revisit this every 4 years and take a look at it. Doesn't mean they're going to change the rules or anything, but at least they look at it. Last time they looked at it was 2019. That resulted in some pretty significant changes in 2020 to the definition of accredited. It expanded it to a lot of people who basically were not accredited. But they came out with this report, and let me talk about maybe the 2 or 3 biggest takeaways. I don't want to make this a whole, summary of a 80, 100-page document. But the bottom line from my perspective is I feel like the SEC has been watching my content and this content. Like I literally was reading this. I'm like, that's what I've been saying for the last 18 months. I think somebody over there at the commission, whoever you are, I appreciate you watching my content, but basically almost word for word has been saying this report, especially the first third of it, is basically whatever is on Mauricio's YouTube. So anyway, they focused heavily on 3 things. The first thing they focused heavily was on this idea that when this thing passed, to Kyle's point, was back in 1982, and that was when the $1 million threshold came up. So you were accredited in 1982 if you made $1 million. If you adjust that for inflation, which is what the SEC said, like if you adjust that for the inflation based on CPI, you come to $3,037,840. That's what $1 million in 1982 dollars means today. So they're starting to look at that. Hey, should we increase it to $3,037,840? That's something interesting to look at, because back in 1982. Only 1.8%, so less than 2% of households, and they had to go with households because that's the data that they have. They don't have it on individuals, but less than 2% of households were accredited back in 1982.
475,000 people.
But also, correct me if I'm wrong, back then, though, you could use your primary residence, right? That was an update that they did to...
Correct. Yeah, 100%. Yes, 100%. You could use, because that didn't come out until just recently, I think 2000, or I forget the name, with the 2012 or whatever the number was. That's when they added it to it. So 1983, less than 2%. 1989, it went up to 3%, 2.8 million people. In 2022, that number is almost 20%. It's 18.5%. Right. And I thought what was interesting is they continued the exercise. They said, hey, what if this trend continues? What is that percentage of people or actually households that are going to be accredited? They said by 2032, that number is 31%. By 2042, that number is almost 50%. And by 2052, that number would be 65% of people. And the reason this is important is because most of the regulations that the regulators pass are geared to protect the little guy, right? The non-accredited investor. And when they did a deep dive on the numbers and the data, which I know, Jay, you're a big data geek. And if you're a data geek, you should definitely read this report. 9 of the 10 million investors that have invested in private offerings since 1982, 10 million investors that have done that, 99.7% of those are accredited today or have been accredited, which means only 0.3% are non-accredited. So that means they can only control or affect that small little percentage of 0.3% of people, that non-accredited. So what they're looking at is to really redo the definition of accredited investor to really shrink that pool down again. So there's all these people who are accredited. They want to make less people accredited. And so the question is, how do they do that? I've been pounding the table and saying, hey, I think they're going to increase it to my number's been $3 million. I've been on record on this podcast and on my channel, $3 million. And because that's just what adjusted for inflation, $1 million in 1982 was. So I think that's where they're heading. And this first part of the report seems to indicate that that's something they have their eye on, because that's something that is pretty obvious to all of us. What was interesting, which is number 2 for me, which it wasn't even on my radar. And I thought this was fascinating. And I'd love to get your take on this, guys. But they focused a lot on IRA money, right? So IRAs back in 1982 were a really small percentage of people's net worth. I think it was like, I've got the number here somewhere around like 3% or something. Or no, 2.5% in 1980 were actually IRA money. Because back then people had pensions, they had sort of defined benefit plans. Today that number's 35%. So they went through an analysis to look at what would the accredited investor look like if we removed the IRA component to your net worth. So when you're calculating your net worth, which is trying to get to that $1 million number, all your assets minus all your liabilities, what would happen if we took away your ability to use your IRA money as an asset, to count it as an asset? And they came out with the calculations. And honestly, it wasn't a huge number. I think it went down from like 12.5% down to 8% or something. But that was definitely, yeah, maybe that's huge. That was a huge focus of the report. Like the big meat of the report had to do with IRA money and why, all the things behind it. So that opened my eyes to say, well, maybe that's definitely another lever they can pull. So they can pull the inflation lever, which is, hey, let's adjust it to adjust for inflation. But they can also pull the lever of the IRA money, because that's become
Why would they do that though? Like, I guess because the next step to that would be like not allowing people to invest their IRA monies in these deals, right? Because like that would be the logical step if they're saying if you can't count it for your net worth for this calculation, then you shouldn't be able to use it to invest.
They could certainly go there. They didn't go there. But that's definitely an argument that they could make. They actually made an argument somewhere in the report about, hey, if you invest less than 10% of your liquid net worth, then maybe the special rules apply to you. Like maybe you can do that because it's not a big deal. You're only putting in 10% of your money. So they did address that a little bit. But if you remove the IRA, then more people become non-accredited, which is really ultimately what the SEC is looking to do. They're trying to increase the pool of non-accrediteds or decrease the pool of accredited. So there's more people that their regulations will apply to.
And one thing to keep in mind, I mean, if you go back to 1982, 2 things worth noting. One, back in 1982, the maximum amount you could put in your IRA in any given year was $2,000. And number 2, IRAs only started back in 1974, I think. So basically, at the time the original accredited investor rules were passed, IRAs were 8 years old and you could only put $2,000 a year into them. So nobody had more than 16,000 times whatever their return was over that 8 years. Let's say they doubled their money in that 8 years. Nobody had more than $30,000 or $40,000 in their IRA. This wasn't impacting anybody's net worth to any significant degree.
My question, Mauricio, is did they mention at all, and then I got to jump off, guys, I'm going to go right now, but did they mention at all about the test, the accredited investor test? Because that was the thing, is like, I feel like there's not going to be a lot of pushback if they increase it to 3 million, as long as they add in this other option for people to get accredited that potentially, because someone who has $2 million in net worth, they've been investing as an accredited investor for years, all of a sudden that gets stripped away from them. Maybe there's another option for them to get in.
Yeah, when Kyle talks about the test, there was a rule, the proposed rule that came out from the SEC that said, hey, instead of relying on your net worth, your income, all this stuff, maybe there's a route where they can become certified. You can go take an exam, a test, and if you pass a test, you become certified and you become an accredited investor that way. And my thesis has been over the last 18 months that that's what's going to happen. I think the accredited investor definition is going to go up to whether it's 2 million or 3 million. It's going to be up higher. So less people will become accredited. But the second option is you're going to go be able to take this test. And that's already a proposed rule by the SEC that got tabled because it was passed during the past administration. And this administration, Commissioner Geisler doesn't seem to have any interest in doing it. This particular report to address Kyle's specific question made zero reference to the test, zero. So they're just focusing on this part. But I've talked about this before on the pod that a lot of the commissioners, I think, are waiting for this update to happen before they go ahead and greenlight the test. They want both of them. They don't want one or the other. They want the ability to say, hey, you're not going to automatically qualify as an accredited investor by your income, or if you do, it's going to be very high, 3 million. But when you fall through the cracks because you're no longer accredited because you're less than 3 million, you're going to have this option to take a test. So I think that's where we're ultimately going to go, but we haven't gotten
When
there
did
yet.
this actual set into place, Mauricio? So walk people through the accreditation piece. Like this was after the Great Depression, right? That's when they set up laws.
No, well, yes. Those are the securities laws in general. The securities laws of 1932, 1933 was right after the panic of the panic of 1928, 29, and then the Great Depression. They passed all these laws to protect the investors. So it was a consumer protection law after the whole debacle of the Great Depression, right? The stock market collapsed, everything. A lot of people lost a lot of their money. That's when the Fed actually had just been created in 1913. So that's when this originally passed. But from 1933 to 1982, there wasn't a specific exemption or regulations that specifically addressed how you could raise capital. It just basically said, look, if you're raising capital, you've got to register. But if it's a private offering, you don't have to register, whatever. But there was no details on how that would work specifically on the private stuff. It wasn't until 1982 that Regulation D, which is what we all know of, actually came to fruition, which said, hey, let's give you some clarity. Like if you can fulfill the requirements under Regulation D, and that's where this accredited investor thing came up, then you're going to be good. You're going to be exempt from having to go public and basically do an IPO and all that stuff. So that's why 1982 is so pivotal, because that's when Reg D passed. That's when Rule 506 passed, which now we know it as 506B, but back then there was only one, so it was 506. And that's where they came out with the rule and said, look, if you're raising capital, you're going to be limited under this particular exemption to a limited number of non-accredited investors, which is 35, and we're going to define what an accredited investor means for purpose of this regulation, which is $1 million in net worth. At that time, it was just $1 million in net worth or $200,000 in income for the last 2 years with a reasonable expectation of earning that this year. And if you wanted to combine that with a spouse, it was up to 300. Don't even get me started on the income side, because if you adjust income for inflation, and they did that in the report, they said, look, $200,000 back in 1982 is the equivalent of $607,000 today. So in theory, you'd have to make $607,000 a year to become an accredited investor today if we applied the same rules that we did back in 1982. I don't think that's even remotely going to happen. Maybe I can have the help of the pod listeners, but what I'm trying to figure out, and I haven't spent a ton of time on it, but what I'm trying to figure out, because I think this is the way you calculate it, is what percentile of income were you in 1982 if you earned $200,000 a year? Was I in the top 1%, top 0.5%? What was my percentage of income? And then reverse engineer it and figure out what that number is today. And that, I think, would be the new limit on the income side, because all the focus right now has been on the net worth side, whether it's $1 million or 3 million. Nobody's talked about the income side. But if you tell me, Mauricio, back in 1982, if you made $200,000, you're in the 0.1% of income earners, then I would come today and say, well, what makes you the top 1.1% of income earners today? And that would be the new threshold for the SEC. But
it just seems crazy that we would go back to even 1982 numbers, just given the fact that the investing landscape has changed so much since then. I mean, back then, like you said, Reg D was new, which I assume means that if you wanted to raise money for something like this before 1982, you needed to go through a securities offering, which takes a year and a half to file for.
Exemption. There just wasn't a safe harbor. It was very vague. You had to rely on court cases and SEC, no action letters. Like you said, you had to register your syndication unless it was private. It's like, well, what the hell does that mean? It's private. And so then all these court cases and judges were telling you what it meant when you were private. And so you had to just it wasn't a guess, but it wasn't very clear. What Reg D did And what we love about Reg D, specifically 506B or 506C these days, is that they're safe harbors, meaning I know what the rules are. And if I follow these rules, I'm assured of being in compliance with my exemption versus if I don't have. By the way, today you can rely on it without Reg D. You can remove Reg D and still argue that I'm exempt under the federal securities laws under Section 4A2.
You just might have to convince a judge and jury.
Yeah, it's like, well, I'm trying to, oh, it wasn't private. I just picked up the phone and made a phone call. You'd have to argue literally facts and circumstances every time. There's no set of rules. So
my question is, though, like, I mean, when you take the environment that these rules were made, and one of the big things with protecting consumers and lack of information. I mean, go back to 1980. You have somebody that shows up at your house and says, I've got a great opportunity for you to invest. There's no way you can find out anything about these people, these things. It's, I mean, the investing world, I mean, even think about, okay, real estate or anything else that you can imagine investing in. What information do you have access to? Okay, I want you to go into a multifamily opportunity with me. All right, where's it at? It's in Chicago. Okay, I'm in Arizona. I don't know anything about it. Trust me, it's amazing, right? Where today you go, okay, where is it? Give me the address. I look it up. I can basically see, I can see who you are. I can Google you and say, show me all lawsuits brought against you. I mean, it's, I think that we just live in such a different age. Some of these things that were put into place were predicated on the way investments were transacted, the way that they were done, and two, the way that consumers were getting basically harmed. And so I don't think it's as easy as just transferring it from back then to today and say, oh, it's the same thing, so it should just be this because it was then at that time. The investing world and landscape is just so wildly different, and the opportunity and access for investors it's nothing like it used to be.
Yeah, that's a great point, because the whole point of this is to make sure that, because remember, let me just backtrack. If you are an accredited investor, technically the sponsor doesn't have to give you all the disclosures. They can just give you whatever disclosures they want to give you. Now they have to be complete, and so there's a process there. But really, it's not until you're a non-accredited investor that you get all these protections because, hey, you don't have access to information, to your point, AJ. So we want the sponsors to put that responsibility to give you that information. But to your point, today with the internet, right, with ChatGPT, with whatever, I mean, literally you can get a satellite photo. Like I remember, not to digress, but I remember I had a case when I was in my law firm my first year, and we had to take a picture of a track. We had to pay somebody to get on a plane, go fly over the track. It was a racetrack, and take photos of the track because we needed to see where the accident happened and what the conditions were and all that stuff. Today, freaking Google Earth, boom, you're there. Like it's so easy to get the information today than it was back even when I was practicing law at the law firm in 1999 or whatever it was.
Well, here's one more data point that I think is interesting. I'm curious your take on this, Mauricio. Well, let me ask you a question before I get to my point. In order to change the accredited investor rules, is this something the SEC can do on their own, or do they need Congress to make the changes?
No, they'll do this on their own. What the next step here is, which I think is exactly what's going to happen, is you're going to see the SEC come out with a proposed rule. They're going to come out with a proposal saying this is what we think is going to happen. And they then submit the proposed rule and they ask for comments. They say, AJ, Jay, Mauricio, you guys are in this market. Give us comments. What do you guys think? Give me feedback on the stuff. And they collect all these comments. And after 60 days or whatever comments, they take that into consideration. And they usually then provide a final rule, usually a couple of quarters. It takes them a while. So maybe 6 months from there, they come out with a final rule. And sometimes they take it all into consideration. Sometimes they change the proposed rule based on the feedback. Sometimes they don't. But that's the next rule. But that's totally within the purview of the SEC because the statute itself, Congress is pretty broad. I mean, Congress basically says something to the effect of, you got to protect investors, right? And you guys figure out the details of how you want to do that, but you're mandated to go protect the little guy. And so now the SEC has that mandate. Let's go protect the little guy. They'll come out with a regulation specific to that stuff. So it's fully under the purview of the SEC. And that's why they do these. Now, that doesn't prevent Congress, which they have, by the way, right? So Congress, for example, has now come into play on the test thing that Kyle was just mentioning. So the SEC passed a proposed rule saying, hey, maybe a test would work. That's gone nowhere. So Congress has now stepped in and is basically forcing them to do it. They passed the House of Representatives passed a law overwhelmingly. They said, hey, let's take a test. Let's make sure the test, people can take a test to become accredited versus just being, wealthy from a financial standpoint. That is making its way through Congress. It's in the Senate. It passed the House. It obviously needs to now pass the Senate, and it has to be signed by the president. But that's making its way through Congress.
I think there's easier ways. So, for example, instead of doing that, if Congress would just tell us the information they have when they trade stocks, I mean, we would never lose. We'd have $200 million portfolios and $400 million, just like Nancy Pelosi.
Well, here's my point when I started on that pulling that thread. So take a guess at what most Congress people make in a year.
From their salary from Congress?
Yeah.
Like 250.
150?
Less, 174. So assuming most of them are married and their spouse doesn't work, and I'm not saying that's the case, but if they're married and their spouse doesn't make another 125K, they don't pass the income side. What do you think the median net worth?
10 million.
15 million?
In 2020, the median net worth for Congress was $1,008,000.
And that's only because there's new ones.
That's a good point. I got you. I see where you're going now. Yeah.
Literally 50% of Congress would be shut out from investing in these types of alternative investments if the criteria for accredited investor were raised at all.
That's a great point, Jay. That's an amazing point, because even though Congress doesn't get to decide directly. I mean, yes, they can pass a new law that says, I mean, there's nothing that prevents Congress saying, look, the new accredited investor definition is this. I mean, that's it. Like that can be passed. But let's not kid ourselves. They have a lot of influence when they pick up the phone and demand that the commissioner show up in their office and like, dude, you got to do this, you got to do that. So, what I've said all along too, by the way, is I still think it's 3 million, but there's nothing that says they could come out with a proposed rule saying 3 million. You get all this pushback, and then they pull it down to 2 million or 1.5 million, whatever. Or what they've been talking about, and this is like the final thing on the report, is they were talking about maybe adjusting it geographically, right? Because $1 million in Nebraska, not to pick on Nebraska, is wildly different. I mean, let's talk about Idaho. I mean, Jesus, Idaho, right? $1 million in Idaho is different from $1 million in New York and California, right?
Oh, it's not comparable anymore. They're so far. It used to be more in line. I mean, today they're different worlds. They're different countries. I mean, they really are.
Idaho, we know that's not a real place.
It's not a real place. It's like this thing.
Idaho is like a bunch of potatoes or something, right?
Yeah, it's just like a bunch of mountains. There ain't nothing here.
Iowa. I always get Idaho and Iowa confused.
We have potatoes and mountains. They have corn and nothing.
All right. Well, we should do a pod at your house, by the way. You need to invite us all to your house, and we'll do a podcast in Idaho direct from,
I like it.
Well, we don't want to say exactly where you live, but in Idaho. But anyway, I thought that was interesting because there are other laws that do, like, for example, the homestead exemption, right? So the amount of money that's protected in your home changes not only by state, but by county, right? So like Orange County actually has different homestead exemption, meaning how much of your home equity is protected versus something that's in Kentucky or Nebraska or Idaho. So that actually makes a ton of sense. So bottom line is I saw 3 levers that they're looking at to pull. One is adjusted for inflation, and that could be adjusted for inflation back to 1982. It could be adjusted for inflation moving forward. It could be both. But inflation's one lever, IRA is another lever that they could pull, and then geographical is another layer. Those are really the 3 main points that I saw in the report of how they could go about. But the bottom line is they want to reduce the pool of accredited investors.
But I think too, the heart of it is to protect. So, I'm all about protecting, not barring out, right? So those are very different things. And I love the idea of you have a way that you can be educated, because that's the point of it, right? Like, is the point to limit access, or is the point to make sure that the people that have access aren't getting tricked or fooled or don't know what they're doing?
The point is to regulate.
Unfortunately. Okay. With that said, I'm gonna jump into the Kyle role of taking over here, and he had to jump on a connecting flight from Chicago. So top 10. I think Kyle had tapped you on the shoulder, Mauricio, the guy that makes fun of his top 10 every week, to do our top 10. So have you prepared a top 10 for us for this week?
So here's the thing. I really wanted to do a particular top 10 list. And what I was going to do today was the top 10 worst top 10s that Kyle has ever done on the pod. That was what I really wanted to do. I was going to go back to all 28 episodes, look at the top 10s he did, and just rank them from worst 1 to 10. But the honest truth is I completely forgot about that. And so when we popped in today and he said, I was like, fuck, I forgot. So I went to my backup plan, and my backup plan is always, as it should be for everyone that's listening and that's here, is I went to ChatGPT. And so I went to ChatGPT and I said, what are the top 10 most common Christmas gifts typically included? Now, because I don't like the top 10, we're going to do the top 7.5 list. And so what are the top 7.5 list, guys, the most common Christmas gifts that you think America gives out on Christmas Day, which is literally 4 days away, 5 days away?
Well, if it's anything like Hanukkah, I'm going with socks and underwear.
Socks and underwear is nowhere to be found on this list, except unless you want to call it clothing, which is really maybe, but clothing's kind of but okay, maybe I'll give you that one.
Okay.
AJ, do you care? I know this is AJ, I know this is a complete waste of time, and I apologize for having to put you through this exercise, but I'll give you one more guess and then I'll just give it to you.
What was Jay's?
Socks and underwear.
Yeah, socks and underwear.
I think it's, hold on, pajamas.
So that's also clothing. So number one was gift cards, believe it or not. Number one gift is gift cards for flexibility and convenience. Number two is clothing and accessories, which includes scarves, gloves, and whatever. Number three is electronics, smartphones, tablets, gadgets. Number four is toys and games. Number five is books. Number six is chocolates and sweets. Number seven is beauty products. And number 7.5 is home decor, candles, picture frames, or ornaments. So there you have it, the top 7.5. Maybe next week I'll prepare the top 10 worst top 10 that Kyle's ever done. And when he tries to do it, I'll just interrupt him and bulldoze him and just overwhelm him.
Okay. Before we move on, I want to do a game because we also do a game, and I'm going to do one that my kids asked the other day. It's a would you rather. Would you rather know?
Are we going to spin the bottle next? What do we?
They're not that old. Give them a year or two, then they'll be playing that game. Would you rather know when you're going to die or how you're going to die?
How, for sure. I don't want to know when.
How? That's tough because if it's in a car accident, then you're never going to want to get in a car again.
That's great. That's great. If you never get into a car ever again, then there's no way you could die.
But time is just that's the countdown to hell. That's just like I think that would screw with you so much every single day. I don't know.
Or it could motivate you big time to live life. It could also motivate you big time to live life to the fullest.
Well, even if I told you you're going to die when you're 90, which is longer by a good bit, like 15 years longer than the average lifespan, now you're thinking I'm going to die when I'm 90. That's the point. People don't think about the fact that it's inevitable. So just assume you're going to die when you're 90, and maybe that changes the way you live your life.
Dude, if I don't make it to 90, I'm going to be really pissed.
Dude, I don't want to make it to 90.
I don't want to make it to 90.
Are you serious?
Yeah, I'm serious.
Let's drop that in the comment. Who wants to make it to, and I'm not talking about make it to 90 like Jay and AJ are going to make it where they're like, can barely walk. I'm talking about doing like Iron Man at 90.
Okay, well, that's obviously different. Show me some guys that are really killing
Dude,
it.
have you seen the Iron Man in Hawaii? You get these like 70, 80-year-olds. Have you seen the 100-meter dash with the 100-year-olds?
70 or 80s, that's what I'm talking about. 88, I'm out.
I want to be the 100-year-old who's running the 100-meter dash in 23.3 seconds. That's what I want.
Yeah, if I can do that, then yeah, but I'm not going to be able to do that, so no.
You can't run 100 meters today.
I can't run 2 meters today.
Okay. Let's move on to the final segment. What do you guys got to plug, Mauricio?
I am going to plug. Dude, I'm on Instagram. I've been obsessed. I found Instagram out like literally 2 weeks ago.
That is the most boomer thing I've ever heard.
I've been posting like stories like they're going out of style. I started a new series called Mornings with Mauricio, which is me walking. I do a walk every morning, and I just drop some value bombs. I drop value bombs on my walks, and I do inspirational quotes. I do SEC stuff. So Instagram at Mauricio Raoul. Follow me.
There you go, AJ.
So let me think. We have our investor first model that we have, which is kind of a crazy cool thing that we do because how our structure is, but we really simplified it. But we just 100% until 120%. So just all dollars go to the investors until we hit our 120% return, called our investor first model. It was kind of how our old structure was set up, but I think it got confusing with like prefs, things like that. So we're just like, all right, everything's a pref until you hit that model.
That's very cool. I'm a big fan of aligning incentives, and that aligns your incentives with your investors. It puts them first. That's awesome.
Kyle, what do you got? I mean, sorry, Kyle. Hey, Jay, what do you got?
Well, I was going to make fun of you for the Instagram thing, but as of a few days ago, I'm all over Twitter. I decided I'm going to try this Twitter thing.
Wait, you mean X? You mean X?
X, yes, X. I've had an account since 2009, but I never post on it, so I decided to start posting. And so follow me on X or Twitter, whichever you prefer. I guess it's X, formerly known as Twitter, at JScottInvestor. So yeah, follow me. Okay. And Kyle is not here. So I am going to plug his wife for him while he's on an airplane. And I'm gonna say follow his wife, Bad Ash Investor, who is just as smart as I am, but much better looking. I think, what am I supposed to say next?
My drink is empty, and I gotta go take a piss or something.
My drink is gone. I gotta hit the head. So I will see.
About Tuesday or Thursday.
I will see you guys next Tuesday. Actually, I will
Actually,
not.
we won't.
Merry Christmas, everybody. Happy holidays. Happy past Hanukkah. Happy New Year. We will not be here next week because it's the day after Christmas.
Hanukkah was last week. We didn't even say anything. Wow.
Yeah, I know.
On the record, I wanted to do the pod. These guys are slackers. They didn't want to do the pod. If you thought we should have done the pod, just drop a comment because I want to do the pod.
We will be back on January 3rd with our 2024 prediction episode. So make sure you tune in on January 3rd.
Thanks, everybody.
Thanks,
everybody.